everyone. This is Rob Keynes with the Freedom Report. It is June 18th, 2024. We'll be at the PortFest conference later this week in New Hampshire. You can reach us or reach the website there at portfest.com. If you want to come out and see me, I'll be there Friday and Saturday talking about freedom and discussing a lot of things related to freedom, sound money with Citizens for Sound Money. And as myself at the conference, I'll be giving a presentation, an update on the future of money, including CBDCs, barter, cash, cryptos, and all of that. So please join us there. Without further ado, let's get into the weekly market report. We've got a lot to talk about. Following up on the economic calendar from last week, consumer prices were slightly down at 3.3% versus the 3.4% that was reported the previous month, although nobody really believes that at this point, the inflation numbers. The thing is, inflation's not really going down. It's still elevated above the Fed's original target. They're talking about moving that target. Of course, it's always moving the goalposts. But inflation is persistent, which we expected to see this time of year. Overall, that was basically initial jobless claims last week. Last Thursday came out higher than expected, 242,000, almost 20,000 higher than expected. Unemployment number actually went up from 3.9 to 4.0. I think I discussed that last week. So overall, the employment situation is not good. And anybody looking for a job probably has the same experience. You're applying for a job that's posted and they're writing back saying, at this time, we're looking at other candidates. And I've heard this happen, a lot of people that I know and through just reports out on the internet and social media. And I think essentially what's happening is companies are collecting resumes, but they're not pulling the trigger on open positions. They're waiting to see whether they need to fill. They're not backfilling positions of people leaving to other jobs or getting laid off. And I think the employment situation has gotten pretty bad. The Empire State Manufacturing Survey came out this week and it was a -6. That's better than the -15.6 it was last time, which was just a complete collapse, but not doing too well either. Consumer confidence is down a little bit on worries about jobs and inflation that came out as well. Looking at the stock market indices right now, the Dow Jones at time of this reporting, about 1 p.m. Central Time, is about 38,820. It's up $42 on the day. The S&P 500 is trading at 54.87. It's up about 14 points. NASDAQ at 17,881.20. It's up about 24 points. And the Russell 2000 2029 up about 7 points. Most of these indices are sitting very near their all-time tops. Of course, they've been that way the last couple of years. As I've stated, with the money printing, it doesn't really mean anything. People with the automated indexing and the capture of money through things like pensions and 401ks and the automation of trading, a lot of the dollars go into the stock market. And it will be the last thing that reflects stress, although we do have stress in the bond market. I posted this on Twitter yesterday, that the entire bond market complex, with the exception of the 7-year, the shorter term bonds are trading at a higher rate than the 10-year. This is yield curve inversion. I've talked about this every week, literally for at least 6 or 7 months. That's the surest indicator in history of an oncoming recession. I believe we're already in a recession. But overall, the bond market's priced the 10-year about 4.225 at time of reporting, all the way up to the 1 month at 5.307. Those are dangerous interest rate levels. As long as the 10-year stays below 4.5, it's stressful, but may not break the actual debt markets, although it puts stress when the government has to roll over at a higher rate than they did before. But once you start getting to 4.5, which, starting at the 2-year and going to shorter term is more expensive, it affects the way that the Fed can affect the yield curve. And that means, what debt would they release in order to pay off old debt? If the shorter term debt is at a higher interest rate, that means if they're rolling over shorter term debt or rolling over shorter term funds due to demand, it's going to cost them more money. So we'll continue to pay attention to that. It doesn't look too good. There's an article here from Zero Hedge. Quote, "It's just not right. Major venues now punishing people for using cash versus plastic." And a quote from the article, "Fans heading to Yankee Stadium hope to pay in cash. At the iconic ballpark for the favorite concessions have been thrown a curveball. Go cashless or pay extra." As the Wall Street Journal reports, Noah Kamala, a 41-year-old New Yorker, found out the hard way. Looking to enjoy some popcorn and soda at a game, Kamala was shocked to discover that his cash was as good as obsolete. Instead, he was directed to a reverse ATM where he inserted $200 only to receive a debit card of $196.50 after he's hit with a $350 service fee and the convenience of going cash fee, according to the article. "It's just not right," Kamala told the outlet, echoing the sentiments of other New Yorkers shocked at what used to save you money. Cash payments now cost more. In some cases, transaction fees have soared to more than $6 for just the privilege of spending your own funds. That's because the cashless society is upon us. I'll show you a couple of exhibits there that are very conclusive and clear about what's going on. Cash is being forced out of the system. It started during 2020 and the shutdowns. where people were running out of cash and felt like either people were hoarding it or the government or the banks weren't replacing it due to the fact it just literally overnight dried up. We didn't think it was because of rampant cash spending. We thought it was because they were not replenishing cash in the system. Some people may have been hoarding for thinking it was an emergency. I've noticed the same thing. This report was from Yankee Stadium, but I've gone to my local ballpark here in Arlington for baseball for the Texas Rangers, and they're almost completely cashless as well. It's very hard to spend cash at a public venue nowadays. I also went to a concert at a nearby House of Blues, a very popular concert place here in Dallas downtown, and they had gone cashless as well. You're not allowed to spend cash in public anymore. A lot of restaurants have these kiosks where it almost forces you to use credit cards all the time. And we're just moving into this cashless society, which we've been predicting for several years. As inflation ticks up, as it gets more expensive to maintain that fiat money, the printers basically can't keep up. And as people are spending more just to be able to make ends meet, this is the situation that we're seeing. And according to IMF and BIS, they want to remove cash from society anyway, heading into central bank digital currencies. And the closer we get to cashless society, by the way, it's also a trigger to me, or an alarm bell for me, that we're getting closer to the end of the current financial system, because about the time that this current financial system will collapse, I think it's about the time that we will be made and forced into some sort of digital currency system, and the cash will basically be either outlawed or it would have inflated so much that it's not worth that much anyway. But I think a lot of it's being taken out. Now, a lot of cash is coming back from overseas in terms of sovereign cash is being back to the United States, and that is causing inflation, but a lot of that's been taken out of the system. As soon as the cash comes back, the banks will take it, institutions will take it, they'll send it to their banks, and the banks will pull it out of the system. So even though a lot of cash is coming in, they're trying to remove as much as possible. And one of the ways to do that to prevent an immediate hyperinflation is to request people use credit, because there's a cost that comes with that, and it's electronic. And it's less obvious to people that cash is worth less when they're spending electronically all the time. Because you keep track of it less. I mean, it's easier to keep track of cash in your wallet. It's a lot harder to keep track of your bills if you're on your credit card bills if you're only looking once a month. So that's a way to kind of take cash out of the system and kind of hide the fact that we're in a pre-hyperinflationary scenario with the dollar. It's not going to work long term, but I think those are the reasons why it's being done. All right, on to the presentation. I want to talk about more around cashless society. Here's a good one that came out from Visual Capitalist. It was an article, and it says, how do America pay for things? Debit card usage is going down. Why? Because that requires a bank account. People don't have as much money in the bank. Cashless society, cash went down 42% between 2016 and 2022, from almost a third of all usage in the economy, this yellow up here, to 18%. That's a 42% fall in 6 years. A lot of that had to do with the shutdowns and the policies after the shutdowns to demonize cash and actually charge more for people using cash, even though cash is cash and the dollar is supposed to be king. Electronic fund transfer went up a bit. That's more for like transactions for payments to people, you know, the types of things. If you're using a Cash App or Venmo, something like that, in addition to like direct deposits and things like that, and deposits from the government to the unemployed, things like that use electronic fund transfer or ACH type of mechanisms. That's gone up, but overall, credit card usage has really taken it up. It's gone up an amazing amount, almost doubled, and that's basically you can see what's going on. Cash use went from 31% down to 18%. Credit card usage in the same time went from exactly the 18% that the cash is at now up to the 31% that was before. So people are simply putting it on their credit card. And by the way, not paying it off, as we're seeing higher credit card balances across the board. So we know where the spending has gone. People have run out of cash and using credit cards. And what the government is doing is forcing electronic usage. A lot of venues and a lot of businesses are as well, under the guise that it costs less to do it, even though the transaction fees are higher on that, because that's basically the move to get out of cash in society and to cover up basically what's going on. And I also want to talk about what's going on with regards to the stocks. There's basically 5 stocks, Microsoft, NVIDIA, Amazon, Google, and Meta, that are giving rise to the S&P 500. In other words, the other 495 stocks are basically sitting at zero. And if you take out, well, S&P 500 dating back to June 23 is at 0% gain. So it hasn't gone anywhere. It's gone sideways. The 38% of gains did come through these top 5 stocks: Microsoft, NVIDIA, Amazon, Google, and Meta. And the rest of the S&P 500 is down 5%. So when you see the S&P up, as I reported at the beginning of the show, it's because these technology companies basically are gobbling up a lot of digital space in terms of cloud storage, AI, those types of things. as we move more to a digital society. So those are going to do well, but it's forming an oligopoly of power sitting atop the stock market, while the rest of the stock market, including commodities, industrials, production, manufacturing, industrials, all that kind of stuff is crashing. That means that as the economy is crashing, the only people making money are the tech companies are getting these big contracts to build out AI and to build out the cashless digital society. And it's pretty clear where that is going. I'll talk about that in a future short about what's going on with AI and the digital economy and how this could lead to greater control and less freedom, along with getting rid of cash in society as well. And we'll make that a subject of a video, but I wanted to move forward and say, if you're worried about this, a great way to get out of the system is to own gold and silver. One of the best ways to do it is with Kinesis. You protect your savings with physical gold and silver. There are 150 million plus in client assets at Kinesis, 0 storage fees, and their yields paid monthly. Even if you're just holding in there and you're not using the Kinesis system to transfer money from one person to another, you do get a holder's yield on what you put in there. And that, combined with 0 storage fees, makes this the best option if you want to buy gold and silver. You're not sure you want to store it all at home. You want to put it in a safe place. You can simply deposit money with Kinesis, buy your KAG or KAU for the silver and the gold, the digitized version that's audited every 6 months, and the report comes out that they have it, and they've been custodian of the assets for quite a long time. And again, you pay 0 storage fees. So compare that to if you're going to store gold with another provider, you may be paying those storage fees. You don't do that with Kinesis. And then if you want eventually get into spending this and sending it to other people, it's a very low cost to do it. It's much less than a wire transfer. It just takes a few seconds to send that money over, and you can send it digitally to anybody else with a Kinesis account. Of course, it does help the channel if you use our affiliate code, which is in the description of the video. And I'll also put a little banner up here as well. Basically, look down there. There is a code you can click on if you sign up and go through the process for signing up with Kinesis to get that gold storage and the ability to transfer almost instantaneously using their system. Also, looking at other options that they have. They don't just trade or have gold and silver. They have other things as well. You can look at everything on their trading platform. It does help the channel. We do get credit for that. And it would go a long ways to helping us produce more videos and higher quality videos that we do, because it pays for our time and effort and the people that we need to produce this. So definitely recommend that to you guys. If you're already decided that you want to get gold and silver and decide on the storage, you've made those decisions, consulted your financial advisor, I think this is a really good option for you. All right, on to the gold and silver report. We're going to look at gold volume here with this chart. Overall volume's down a little bit. That's allowed gold to rise a little bit. We'll get into the COT report in a minute and show you why. Again, when you see the trend down in terms of overall interest in the gold and silver market, it usually means less shorting going on. Concentrated shorting, the largest 4 and 8 traders we talk about every week, and it usually means that price is either going to rise a little bit or at least range trade and not fall. And that's basically what happened the last 7 days. We'll show that on the COT report and on the price report here in just a moment. Looking at the latest data, 439,000 contracts open across all of these different trading months. And note, this is a futures market, so people are gambling on the price of gold in the future and of silver in the future and of other things like oil and sugar and so on and so forth. It's a futures market. It has not a whole lot to do with deliveries, only 537 deliveries. That's because June is not a big contract month. You can see most of the open interest is sitting here in August. And you look at this column right here, 356 of the 439,000 contracts are there in August. So not as many deliveries, although this was a huge month for deliveries. At the beginning of the month, first half of the month, I think it was like 28,000 contracts of gold delivered, much more than we've had basically any time in the past year. So people are definitely going for the gold. Where they can't get it on the COMEX, or using the EFP mechanism I've got highlighted here to go over to the UK and see if they can get it there. They're trading a futures contract position with a position in the OTC over-the-counter market, the unallocated gold and silver markets, and EFP is a mechanism to do that. A lot of times they're hunting for the physical. So a lot of gold is still coming out of the coffers on the American exchange, and where they can't actually get it because there may not be enough, or they can't find the right trading partner, they take it across the pond to see if they can get access to it. Also pay attention to block trades, because that means that 2 parties, or this could be more than 2 parties, but a transaction between 2 parties, maybe multiple different sets of parties, agree sort of off the chain, if you're thinking from a crypto perspective, or off the market using the current pricing. They put that in via the market mechanism that COMEX allows, the electronic platform. And those trades go down as a 1-for-1 trade between 2 parties. And as the block trade goes up, it indicates to me that people are wanting to settle on prices sort of outside the fast-moving market because of volatility, and they may be wanting to get access to that physical as well in terms of deliveries. So we'll continue to pay attention to that. Looking at the settlements tab, we basically just go over prices. For Monday, the price is down about $20 yesterday. In the gold prices, you look at the dominant contract month of August, down about $20.10. You can see here in this column. That's how spot pricing is determined in the market. Don't let anybody tell you any different. It has nothing to do with the physical deliveries. It has more to do with the derivative trading. Now, derivative trading can be affected by physical trading and market factors and things like that, but it is in fact the paper trading that determines the pricing. If we go back to Friday, you see the same thing. It was up 30 bucks. Overall, gold's been allowed to rise a little bit. Again, we'll look at the commitment of traders report and see what the traders are doing. All of the contract data in there will tell you, are there more longs, more shorts, who's doing it, and that tells you basically what affects the price. Because when somebody puts in a big order for longs, it tends to drag the price up. It creates positive bullish sentiment in the market. When people put in a bunch of shorts looking for trades, a corresponding long, it tends to bring the price down, and that's generally what happens. Moving over to silver, as we look at volume and OI, basically the same thing as gold. I realize I'm speaking a little bit fast. I'll slow it down just a bit. Same thing here, same chart, just silver versus gold. We see a decrease in interest, although good interest as of about a week ago, about middle of last week, it's fallen a little bit. And that's basically what kept silver from really spiking, brought it down from, that 31.30 range into the 29s. It's trading right now at, as we speak, 29.50. It's down a penny. It was about even when we started the video. And overall gold's up a little bit, as you can see the prices here. Silver, the dominant month right now is September. That will gradually move to December, the biggest month of the year. But right now it's September, and let's look at what's going on. 176,000 contracts. Each contract represents 5,000 ounces of silver, whereas in gold, you get 100 ounces for a contract. In silver, it's 5,000. So even though less contracts, more overall ounces are being looked at in the derivative market, and therefore a lot more ounces, virtual ounces or paper ounces being traded back and forth on that market, and that of course determines spot price. EP's at 583, only 16 total deliveries across the June month. There were substantive silver deliveries this year, but gold's been the much higher delivered metal than silver, just due to the fact that I think the central banks and the big players in the world know that the fiat demise is coming, the cash crash, if you will, is coming. The move away from cash is coming, so everybody's going for the gold, and is basically just a confirmation of that trend, which is why I brought those charts to you at the beginning of this video. And you look at it, overall block trades 9A6, so people are looking to settle sort of privately and then put that on the exchange afterwards, which indicates to me people are hunting for the physical and trying to do these types of deals outside of the live market, making those deals on the side. As of Monday, we had 82 cents down, 81 cents down, the dominant September month for silver. If we go to Friday, looking at the change column, it's up 40 cents. The only reason I show this tab is just show you this is for spot prices determined. It takes the average of the dominant month's contracts or the nearest dominant month's contracts, and that all blended together gives you the spot price. The system determines that. Well, what's determining what we saw in that previous chart in terms of where the price is moving up or down? Well, this is the COT report, the Commitment of Traders report from the CFTC. It's issued by the regulator. CME Group manages the market. CFT regulates, gets the data from the traders and from the CME Group, and puts this report together. Hence it being about a week late. This is for June 11th. But what it does show you is what the big guys are doing, and puts them in groups. The producer merchants on the left over here are basically the guys that make it, the miners, or dig it out of the ground, if you will, and then refine it and put it into usable form, bars and ingots and that type of thing. The swap dealers are also the bullion banks, or the big trading banks. They're mostly represent speculative position, whereas the producers and the merchants, and when using it after the producers produce it, represent legitimate hedging because they're actually dealing in the physical metal. So their position are to offset upward or downward price risk in the market. For the producers and merchants, the swap dealers can do that for people, but a lot of what they do, because the producer merchants have their own category and hedge a lot of their production and their usage, the swap dealers or the bullion banks don't need to hedge all that for them. Certainly you could have some hedging in there, but I believe most of this is speculative, especially the way they manage their positions. They're super aggressive at trying to get small price changes. That's generally not what a producer merchant's going to do. A producer merchant's going to take a 2 to 3 to 4 month position to offset either what they're going to be buying and using. In the case of a merchant like Apple, which puts silver in its iPhones, or the military or medical companies that use silver, jewelry companies use gold, that type of thing. And the producers want to protect their downside price risk between the time that they're mining it, getting it refined, and getting it out to market. So they'll do legitimate hedging, whereas the swap dealers generally don't. It's more speculative. And the producer merchants will hold longer term positions, and they don't change as much. You can just tell by the number of contracts that change, both long and short. It's much smaller because they're holding long term. The swap dealers are trading many more contracts. You can see that as of this report for gold, we're at gold here. This is gold. They've dropped 7,600 short contracts, meaning, and dropped 1,200 longs. Net going about, net long about 5,200 contracts because he dropped less longs, meaning they held more longs as a percentage. The overall percentage you can see here in this top line. 275,000 short gold contracts to 55,000 long. You can tell the swap dealers have most of the short interest in the market, which is confirmed down here. You look at the 4 or less traders short, 42.4% concentrated. 8 or less traders short, almost 60%. That is a huge number. It means the big banks are basically controlling most of the short position, and they trade in and out so much and have such high volume numbers on a weekly basis. It's speculative. They're just hunting for price differences and maybe trying to move that price to fit the needs of themselves or their clients looking to obtain the metal, buy or sell it. That's what that's for. Managed money position or the financial houses. They're about even on terms of releasing longs and shorts. Why is everybody releasing so many contracts? Well, we're headed into summer. Summer tend to be a little bit of a slowdown in terms of the derivative markets for gold and silver, and even a little bit in the financial markets for things like stocks and bonds as people go on vacation, things like that here in the West. Sometimes people will pull money out of certain markets and park it someplace safe, whether it be gold, silver, Bitcoin, bonds, you know, a diversified portfolio of stocks that they think are super safe, and they'll just lessen their overall trading. So what you're seeing is the overall open interest, this is the open interest column, fell by 10,000. That's the second straight month that has fallen. I think it fell about 4,500 last month in gold. If I remember, I have to go back and look. So overall, it's falling, you know, week by week, month by month basis heading into the summer. And then generally the pattern is it gets more frothy as we get to, you know, the end of August, the second, third week of September. You start to see more interest come into it. That's not always the pattern, but generally. And so what we'll see is a little bit of fade in terms of the overall amount of trading that determines a spot in the derivative markets for gold and silver. But that doesn't mean the price can't change. The prices often, because there's less overall interest, can change more, because at any given position as a percentage of the market, a move up or down is a higher percentage. If you have less overall contracts trading and somebody does make a big positional move, maybe something's going on in the economy, maybe they're protecting, you know, their interest in the gold and silver market, that tends to have a bigger effect. So you can see big price moves in the summer. A lot of times it'll be nice and smooth in June, and then July and August, the gold and silver prices will fade a little bit. What could change that's a black swan, a bank failure, something like that, which could then spike the prices. So that's generally what goes on. A little bit of a preview. Just wanted to give that to people who may not be as up in the gold and silver markets. I know a lot of people, especially millennials, but all generations are looking more at gold and silver to protect their savings as inflation sort of ravages people in the economy, especially people with less assets. So generally looking at Gen Zers, millennials, and people in the mid to lower income spectrums, or people that don't have as many assets. So millennials and Gen Zers definitely don't have as many assets yet, haven't been alive as long, but they also haven't had that big, you know, dollar boom, which inflated their stocks and their bonds and their real estate. It's hard for them to afford new real estate, so they're disproportionately affected, which is why I've said the millennials are going to lead the next charge, and the Gen Zers into gold and silver, because they're most affected by inflation and their lack of assets and the crappy economy and lack of jobs and things like that. So expect to see that going forward. Well, that is gold. Let's go down to silver, I think is above. Here's silver. Here's the silver report also through June 11th. You can see here, not a big change in the producer merchants. They released some shorts overall. The positioning overall, as you can see right here, has gone down in the market. Again, that summer fade. The swap dealers didn't do much here. They released a little bit more short pressure than long pressure on the market. They're still sitting more than 2-to-1 levered short in silver, 68,000 contracts to 31,000. And you can see the 4 largest short positions held by the banks, 31.6%. The top 8 held by the banks, 46.6%. So the concentrated shorting is, again, done by the banks. It's on the report, not conspiracy theory. It's easy to see there. On the other side, the managed money really dropped their longs and went short. The managed money is expecting silver price to go down over the summer. They're betting on a lower silver price, maybe because they're expecting the economy to deflate, and silver is a very commoditized metal used in many products. A lot of silver used is not as money right now. It's being used as a commodity in everything that we produce and use in this digital economy. But they're expecting maybe deflation in the economy. That's a signal to financial houses, what they're seeing in the data. So they're releasing some of their long positions. So we're expecting that price to come down. So overall, that is the commitment of traders report. And again, as you see, gold was allowed to rise a little bit in the last week because of what happened in the commitment of traders report. A lot of swap dealers released a lot of shorts. So the price is allowed to rise a little bit. And if you look at silver, they didn't release as many shorts, only 945. So silver stayed more even. Released more shorts, gold went up over the last week. Released less shorts in silver, silver stayed about sideways. And that is basically a weekly market report. As a reminder, Thursday I'll be traveling. Friday I'll be in New Hampshire for PorcFest. It's porcfest.com if you want to look up the schedule. I'll be a local time, 5 p.m. up on the stage doing my alternatives to the dollar, post-dollar currency alternatives. I think it's what it's called. I'll talk about CBDCs. I'll talk about asset-backed digital currencies like Kinesis, which are on blockchain, which allow you to securely hold gold and silver, pay no storage fees, and actually get a yield for holding that and putting it into the system. And you can get a yields as well for referrals. You can set up your own referral link. You can get yields as well for spending that money, sending it to another Kinesis user as well. And again, we have a referral code down there if you're interested. We've been talking about asset-backed digital currencies, central bank digital currencies. I'll be giving an update there at the conference to the participants. We'll be talking about the dollar, barter, gold, silver, Bitcoin, cryptos, all that type of thing in a presentation. And then Saturday in the morning, I believe it's 8:30 local time, we'll be giving a roundtable with myself and the executive director of Citizens for Sound Money up on the main stage. And then shortly thereafter, Ron Paul follows us. So we'll lead off the day, and then the big fish of the conference, Ron Paul, will be right after us. So please, if you're there in New Hampshire, get up early with us and come see us on the stage. And we'll also be doing some broadcasting to the channel. I'm going to try to do most of the day, Friday and Saturday, on our channel as a stream. We'll see how it holds up. We're out in the middle of the country. We do have a satellite connection. We'll do the best we can to put that live on the channel. We'll also be doing some recordings and bringing that back with us and putting it on the channel as well. So stay tuned to the channel. If we can get it up and the internet connection holds where we are, we'll definitely be streaming some live stuff to our channel this Friday and Saturday as well on the YouTube channel. And we'll see if we can do it on Twitter as well. We'll see. I've actually got more subscribers now on Twitter, or X as they call it. So we'll try to do it, on both platforms, but just pay attention for that. If for some reason internet doesn't hold up, like I said, I'll take some recordings and we'll bring it to the channel afterwards. And we're going to have cool stuff there. I'm bringing some very nice items that we're doing a raffle and a fundraiser for Citizens for Sound Money. We're active legislatively and promoting sound money in various states, including New Hampshire, Florida, South Carolina, Texas, Missouri. What other places are we in? A lot of different states. We're also building an educational function within Citizens for Sound Money to teach people about money and basic finance, to reach out to the people, as well as doing other things as well. So definitely a lot of fundraisers there, a lot of nice items that we can raffle or bid on. So stop by the booth if you're there at PorcFest. Right, this is going to do it for today, guys. Thank you so much. This has been the June 18th, 2024 weekly market report. Stay tuned for some short video and potentially some streaming from the conference later in the week. Until next time, this is Rob Kientz with the Freedom Report.